Good evening, good afternoon to anybody who's watching this. This is Team 2F. We played in the BSG gaming industry too. My name is Joan Ugarte, and I'm here with,
Christina Garrett.
and we decided to call our company Fabulous Shoes. During today's presentation, we're going to be giving you guys an update on our strategy, how it changed over time. We're going to be providing the wholesale North America market analysis for year 11, where we were at compared then to year 17. And then we're going to talk about our historical trends. Then after we're going to go over the strategic competitor that we decided to compete against, if you will, and based on how they played versus how we played. What should we do going forward? And then after, we're going to go to lessons learned. So, without further ado, I leave you with Christina, who's going to talk about the company strategy.
Yes. So for our strategy, as you can see, we had two different strategies. For year 10 through 12, we wanted to craft affordable, stylish footwear in small batches that empower individuality, reduces waste, and redefine value in fashion. And then for years 13 through 17, we moved in a completely different direction. So that's why our strategic vision changed for those years. And that is to be the go to footwear brand that delivers exceptional quality, diverse styles, and everyday affordability, making great shoes accessible to everyone.
So next up, thank you, Christina. So next up, it's going to be the industry analysis. As per the guidance, we were told to analyze the North America wholesale market for year 11 at the beginning of the competition and year 17. And as you can see here for that first year, a lot of people will cluster it into a similar segment of the wholesale market. At the beginning, we decided, as Christina said, our strategy was different, and we were in that quadrant where it's the focus low cost. We were trying to provide lower costs and for those shoes, and then we were in a focused environment, like very few models. At this point in time, we were aggressive cost advantages in a lot of things. We were our SQ rating was not the best or not the highest, if you will, the brand advertisement either. And we had one of the lowest rebates of the whole market, and we had low model availability. So we were a narrow focus approach. Now, at this point in time, as I said, the market conditions were highly competitive. Everybody was in the same cluster, with the exception of two companies, which as per what you see in the map. But you can see that initial push for differentiation with company D and company H, and those were, at least in this part of the game, they were the possible industry leaders, right? They were differentiating themselves from everybody else, from the rest of the group. Company D was a focused differentiation strategy. They were playing on the higher end, so higher SQ rating, higher end models, but it was still focused. Like, it's not a lot of models, right? From the 50 models to that middle to 50, probably right around there. It wasn't a direct competitor for us because we were not trying to play in that high end scale of the market. Then you see company H, which since the beginning, you can see the huge market share they had, even from year 11. They had a broad low cost strategy, which is more models and then, but still maintaining lower cost. So this company H, it seems to to be looking as our direct threat. And they had low price, low quality, broad model availability, and as you saw, the bigger the circle, the bigger the market share. Now, coming to year 17 in the next slide, you can see how everybody sort of spread. At this point in time, year 17, we already did that strategy shift that Christina spoke about in the first slide, and we were already very distinctively playing in the broad low cost strategy. We continue with the cost savings advantages, like lowest Q rating, brand advertisement, rebates were the lowest as well. But we shifted, that strategy, and we stopped doing private label, and we focus only on branded, and we moved to the broader category instead of the focused one. We had a high retailer support, higher than our competitor, and so we were able to compete on distribution a little bit. The market conditions that you can see here, highly segmented, a lot of competition in that high end category, even if it was, broad or focused, it's a lot of competition in that section. Basically, you can see a clear division between the high end versus the low end of the spectrum. And few players on the low end, which was us and Company H, our direct competitor, if you will, and a lot of investments in advertisement and celebrity endorsement. Like a lot of the companies were high bidders with the celebrities, and because they had good company rating, they were able to market themselves better marketing strategies, if you will. Now, the clear industry leaders at this point in time in the last year of the competition were Company A. It was the overall winner. They had a broad differentiation strategy. They had a lot of models, but they were competing in that high end. So they were having, huge margins related to their pricing, right? Huge margins. They had the highest SQ rating of all of the companies in this segment. They had very good ads, high celebrity appeal, high margins. On the other hand, between, Company A, what we did here is just segregate between the two clearly established segments, like the high end versus the low end. So the high end, the winner was Company A. For the low end, the winner was Company H, even though it was the third place in the overall competition, but it was the winner in that segment. They had a similar strategy to ours, broad low cost strategy. They had highest market share, lowest price. Of the overall competition in this segment, and then the highest celebrity appeal with 325, which is insane. Um, um, and at this point in time, obviously, we were clearly competing with them, or at least competing with the same for the same customers, if you will. So, and you'll see how we selected Company H as well for our strategic competitors. So, more to come after after our historical trends, which I'll leave you to with Christina.
Yes, so I'm going to be talking about our stock prices, our net revenue, and our earnings per share. So as of right now, I'll be talking about the net revenue. As you can see, from year 10 to 11, we kind of grew just a little bit with our price. And then at year 12, we took a very big hit from year 11 to 12. And then afterwards, you see that we continued to grow and get a lot more revenue in. We expanded more of our models. So we went from, I think, 250 to, I think, 450 models that were out in the market. We went to where we completely exited from private label and just only focused on brand footwear just because we found out private label wasn't our strongest suit. So we got out of it completely. And then we also upped our wholesale and our internet to kind of battle between us and H. And then on to our earnings per share, I believe. As you can tell, we grew with earnings per share. It's basically kind of the same format as our net revenue. We took a really big hit in year 12, and then after year 12, we just continued to grow until year 16. We took a little bit of a hit, not as big as year 12, but still a hit, and then we just grew to year 17. And then for our stock price, we really had a big hit for this one. We had the same trends for as the previous three. Year 13 is where we took off tremendously. We kind of got our groove. We figured out our market. and just continue growing there until year 16 when we just had a bit of a shortfall. And then after that, we continued to grow again, just like any business. I'll let Joan take it from here for our competitor analysis.
Thank you, Christina. So yeah, for as I was saying in the previous, and you saw from what Christina said on that first slide with the change in that strategy, how all of those trends went up. They follow the same trend, if you will. Now with the competitor analysis, basically we selected company H. I think we were the only ones competing in that low end category, as I said, and again, I I say competitor, there was really no competition because company H, they had huge volumes compared to us. And if you see, for example, here the main metrics that we were measured against, they ranked three, for example, we ranked nine. Like there's a huge gap between us. And almost on all of the other metrics, they doubled us or tripled us in some of them. So it's really our competitor because we're competing for the same customers, but really they were way ahead of us in a lot of the things. I think one of those things, and you can see there, for example, the celebrity appeal for the North American market and for other markets was really high compared to ours. They had greater facilities or greater capacity of manufacturing compared against us. They had 20,000 square foot versus our capacity. They have a better image rating. They had better net profit margins, which obviously ends up showing that the stock price, the return on investment, and the EPS is way higher than ours. So they had very good financial metrics. They had very good overall operational metrics than us. And again, as I said, they were our competitors. Were competing for the same type of customers, which are your bargain customers. They're not really looking for quality. They're really looking for the cheapest option. But then again, because of their volumes, they were able to achieve a lot better metrics and a lot better results than us. Um, so how do we compete against this, right? And how do we make sure that in the next 3 years' time we are able to outdo them if we were gonna continue playing the game? Basically, it's raising the perceived customer value. Right now, at this point in time, we have a better SQ rating than they do. But we have a higher price in our shoes. So they have 50, we have 56. So I think if we initially drop that price a little bit closer to theirs, and we justify that price with our higher SQ rating, we can start munching into their market share. Now, you can see also we have to boost demand. They are competing in the high volume space because they have the capacity, they have all of that playing on their favor. Plus, they have the company rating, they have the image rating as well, higher than ours. So we thought about increasing the model availability even further to continue competing against their availability, also increase the production capacity. Right now, as I said in the previous slide, we had 13,000, they have 20,000 capacity. So they have better capacity than us. So we have to continue improving on that capacity, even if at the beginning we have to invest a lot of money, but it will help us in the long run. We have to increase our brand advertisement for sure. I think we are investing $13 million only, whereas they had $30 million brand advertising, and increase brand reputation. And I think a couple of things we have to do to play there. It would be increase some of our corporate social responsibility initiatives, to be able to improve on that brand reputation, and also outbid some celebrity to boost our image and the reputation, and then thus will help us increase the demand. I think one of our strong suits against them is that we maintain a retail distribution support at this point in time, because we cannot compete with other high-end tiered companies for quality. Then we have to maintain that retail distribution support, which at the moment that we analyze this, they had zero support. We had at least 5 million support. So I think that would give us leverage if we were able to, continue increasing our capacity, improve our brand advertisement, brand reputation, and get a celebrity endorsement, and we would start munching into their into their market share. So I think that without further ado, I'll leave you with Christina for the lessons learned.
So the lessons we learned while playing this game was if we have the money, pay off our loans so that doesn't keep going over our head and we keep have to pay interest. And sometimes if we defaulted, then we would have to pay more in the loan. Um, Continue building capacity in the Asia Pacific region and possibly North America if we chose to be in there, to maintain that low cost strategy that we're trying to go for. We should totally put more offers into celebrities to get a better image rating, even if we have to go higher in price than what we would like. Instead of waiting for depreciation to happen on our equipment, we should have started investing in the equipment sooner. So when the depreciation did hit, it didn't really tank us that far. We should had always tried to meet our investors' requirements. I believe we did that, but that's still a lesson that we should still strive to learn. And then obviously to get more retail support so we can sell more shoes, which to just outbid company H as we currently have been doing.
Yeah. Thank you so much, Christina. I think with that concludes our presentation. Thank you so much for attending, and I'll stop recording now.